Hello everyone! In this video, I will be sharing with you the important terms that you need to know in the stock market. To be profitable in the stock market, we need to understand these terms so we can do our own research diligently and won't be manipulated by the media. If you are a new investor and wanted to be profitable in the stock market, please watch this video until the end as this is a very important video for you. Please take out your pen and make a note if necessary. After this video, you will be able to discuss the stock market with others easily. I am M from DJM Investment Journal. Please subscribe and turn on the notification bell if you have not done so to get our latest updates on our investment series for new investors. Stock, share, stock market, shareholder, stock exchange, and IPO were already explained in our previous video. If you have not watched it yet, please refer to the video on the top right corner here for the detailed explanation. Just a quick recap. A share is the single smallest denomination of a company's stock. Shareholder is the person who owns a share of the company. Stock exchange is where the company lists their share to trade publicly. IPO is the process by which a private company can go public by selling its stock to general public to raise money to expand their business. Now let us move to the first part of the video where I will talk about the terms to describe market conditions. The first term is bull market. Bull market refers to a market condition when prices continue to rise or expected to rise. By contrast, bear market refers to a market condition when prices continue to decline or expected to decline. Technically, bear market happens when the price has fallen 20% or more from recent highs. One of the commonly held beliefs about why bull and bear are used to describe the market condition is from the way the animals attack their opponents. A bull thrusts its horn up to the air while a bear swipes its paws downward. We can also use these two terms to describe our point of view. If I'm bullish on this stock, means I have confidence it will be going up. Bearish view means I expect the stock will be going down. Bull and bear market on different sectors can happen at the same time. For instance, while most of the index and sectors are in bull market, ARK Innovation ETF fall into bear market territories in the first week of March 2021. Next, let us understand the term trend. In general, we can classify trends into uptrend, downtrend, and consolidation. Here is an example of a chart with an uptrend pattern. We can see that the overall movement of the price is going up. We can also observe higher high and higher low along the trend. By contrast, downtrend is a trend where the overall movement of the price is going downward. You can observe lower high and lower low along the trend. Consolidation means the stock is neither moving upward or downward in a clear direction. Instead, it remains range-bound. We will talk more about this in our technical analysis video. Now let us further look into the terms used to describe different phases of bull or bear markets. Here is a typical bull market with an uptrend pattern. During the bull market, the price is going higher. This brings a new term, rally. Bull market rally is a period of continuous increase in the stock price. However, it does not move in a straight line, correct? Do you notice there are periods where a short decline happens? This part is called retracement. In short, retracement is a temporary price reversal that takes place within a larger trend. If the retracement is within 10 or 20% from the high, this is called market correction. If we refer to the Nasdaq in February and March this year, the retracement was around 11%. This retracement is called correction. If the stock price experiences a two-digit percentage drop within a short period of time, we can call this a market crash. Some infamous examples of market crashes are below: the dot-com bubble burst in 2001, the 2008 financial crisis, and the most recent COVID-19 pandemic in year 2020. Now, the stock market has retraced 20% from its recent high. Bear market is coming. In a bear market with a downtrend, here are the terms we need to know. When the stock price goes down, it does not move in a straight line too. Most of the time, downtrends are interrupted by a brief periods of recovery or small rallies when prices temporarily rise. This part is also called retracement in a downtrend. However, there are also several specific terms to describe them: sucker rally, bear market rally, or a dead cat bounce. If you heard these terms in future, it generally signifies the upward movement is temporary and people are expecting the price to continue to drop. Reversal in stock market is a change in the major direction or trend of the stock price, but sometimes a reversal is a false signal. A false reversal signals can cause bull trap or bear trap depending on the trend. Now let us look at the terms generally used to describe stocks. Stock index is a basket of securities that measures the price performance. Each country has its own major index. In the US, 3 major indices are: number 1, Dow Jones Industrial Average. You can also call it Dow Jones or simply the Dow 30. Dow Jones tracks the performance of 30 large companies in the US from different sectors. Examples of famous companies in Dow Jones as of March 2021 are Apple, Boeing, Microsoft, Visa, Nike, Disney, and Coca-Cola. Number 2 is Standard & Poor's 500 Index. S&P 500 tracks the stocks of 500 large-cap US companies. As S&P 500 is tracking top 500 companies, it is my favorite benchmark to analyze the market. In addition, with 500 top companies, it is also a well-diversified index. Therefore, SPY, S&P 500 ETF Trust, an ETF that tracks S&P 500 is one of my favorite ETFs to deposit my cash to grow my wealth. And the third is Nasdaq Composite Index. The Nasdaq Composite Index tracks the prices of all securities traded on Nasdaq Stock Exchange. As more than 40 to 45% of the companies listed in Nasdaq are in technology sector, the movement of the index is heavily influenced by what is happening in the technology sector. Nasdaq 100 Index, which includes 100 largest domestic and international non-financial companies listed on the Nasdaq Stock Exchange based on market capitalization, is also a good benchmark to be analyzed. In other countries, the popular indices include Straits Times Index for Singapore, Kuala Lumpur Composite Index for Malaysia, Hang Seng Index for Hong Kong, and Nikkei 225 Index for Japan. I will post a link that lists most of the popular indices in other countries. Please refer to the description below. Indices or benchmarks are used to track the market performance. However, we could not buy or sell indices or benchmark. Instead, we can invest or trade the exchange-traded funds, ETF, that tracks an index. Before we talk about ETFs, let us first understand the terms used in investing and trading. Investment is purchasing assets that have the potential to produce income or profit. In short, we invest in the asset that we expect the value will appreciate and grow our wealth gradually. In general, investment takes over an extended period like years or even decades through buying and holding. By contrast, trading involves frequent transactions in a much shorter time frame. It could be a quarter of a year, a month, a week, a day, or even within a few minutes. Buy or long. When we buy a stock or long a stock, it signifies that we are buying a share and hoping for the price to go up. In this case, as a buyer, we buy a share to open the position. We then can sell the share to another buyer. In this case, we are the seller. We sell the share to close the position. In this case, if the selling price is higher than the buying price, the difference is called profit. The increase in the stock value is called capital gain. If we do not sell it, it is called unrealized profit or paper gain. If we sell the asset and pocket the money, it is called realized profit. If the selling price is lower than the buying price, then the difference is called loss. Similarly, if you have not sold the asset at loss, it is considered as unrealized loss or paper loss. If we sold the asset, then it is called realized loss. Using this chart as an example, if we bought the stock at $102 here, then we sell at $120 over here, we will make a realized profit or a capital gain of $18 per share. However, if we bought the stock at $110 here, but selling at $100 here, we realized loss or capital loss would be $10 per share. Investment is a buy and hold strategy only, but this is not the case for trading. Other than buy or long the stock, we can also short or sell the stock. As we know, the market also moves in downward direction during correction, market crash, or even bear market. But do you know that we can also make profit in a downward movement? We can do that by using short selling. Short selling is where we sell the shares to someone else without holding the shares at the first place. So we need to borrow the stock from someone else, for example, a broker. In this case, we are the sellers who sell a share to open the position. As we borrow the stock from the broker, we are obligated to return the share. Therefore, we need to buy the share back and return it. So how do we profit from it? Let us come back to the same chart again. We do not have any Microsoft stock, but we anticipate the stock will go down in near future. Therefore, we borrow the stock from a broker and sell it to a buyer at $110 per share. We received $110 as a credit. When the stock falls at $100, we decided to buy the stock back. Instead of $110, we only buy it back at $100 from a seller. As the broker doesn't really care about the price, we just need to return the share to them. So after we return the share to the broker, we would pocket the $10 per share as our profit because we received $110 from a buyer, but only used $100 to buy it back. Still do not understand? Let us use this as an example. A and B are good friends. A is going overseas for a year. So he asked B to take care of his brand new iPhone 11. In this scenario, A is the owner while B is not. This means B is obligated to return A the iPhone when A is back. While A is away, B sells this iPhone 11 at $1,000. 1 year later, B is reminded to return A the iPhone 11. At that time, iPhone 12 has already launched, so the market price for iPhone 11 is therefore only around $600. So B then purchases a new iPhone 11 at $600 and returns it to A. A still gets his iPhone 11 without knowing that B, the short seller, has profited $400 in this process. Please take note that the maximum we can earn as a short seller is when the stock price drops to zero, as it requires us $0 to buy it back and return to the broker. But the risk is unlimited because in principle, the stock price can go infinitely high. Here is the summary table to differentiate long buyer and short seller. You may want to take out your pen and make some notes here. Before I continue to the next part, I hope you learned something new here. As we really spend a lot of time to deliver the best to you, plus we are going to prepare more videos to help you to kickstart your investing journey, I hope you could click on the like button to motivate us more. If you have not subscribed to our channel, please click on the subscribe button and turn on the notification bell to get our latest updates. If you think that this video could help others, please feel free to share it too. Now, let us talk about the terms related to the company that we can buy on the stock exchange. Let's start with ETF, or exchange traded funds. An ETF is a security that tracks an index, a commodity, or a basket of assets, but we can trade them like a stock in the stock exchange. We can buy it, short it, invest it, or trade it via a stock exchange. As I mentioned in the previous part, we could not buy and sell index or the benchmarks like Dow 30 or S&P 500, but we can buy or sell the ETF that tracks them. Please refer to this table on the ETF that tracks the benchmarks. Next, let us look at the terms related to the stock classification. For individual stock, the first term we need to know is ticker. Ticker is also known as symbol of a stock. For example, Apple's ticker is AAPL, Tesla's ticker is TSLA, and McDonald's ticker is MCD. We use ticker to look for the stock in a broker's platform. Next, we touch on market capitalization or market cap. According to Investopedia, market capitalization refers to the total dollar market value of a company's outstanding shares of stock. To calculate the market cap, we multiply the total number of outstanding shares of a company with its current traded price. For example, a company has 1 million shares trading at $50 each. Its market cap is 1 million times $50, that equals to $50 million. In general, a company with a market cap of more than $10 billion is considered large cap. Mid-cap company has a market cap of $2 to $10 billion. Small cap company has a market cap of $300 million to $2 billion. Company with lesser than $300 million is considered micro-cap company. Generally, market capitalization corresponds to a company's stage in its business development. Large-cap companies are generally matured, well-known companies within established industries. They are very stable and is the least susceptible in economic downturn. Mid-cap companies are in the stage of experiencing rapid growth. Mid-caps may offer more growth potential than large caps. Small caps are young companies and the most susceptible to the economic downturn. Next, may be the term that you kept hearing. It is the blue chip. In general, blue chip stock refers to the well-recognized company with good reputation. Typically, they are large, well-established, and financially sound companies that have operated for many years. They are often the market leaders in their respective industries. However, not all blue chips are worth to invest. We still need to combine fundamental and technical analysis to invest in a good blue chip that is not in the sunset industry. We will talk more about this in our future videos. Talking about blue chips, then we should know the most famous blue chips, the tech giants in the technology sector. FANG or FAM. F is Facebook, A is Apple, another A is Amazon, N for Netflix, M is Microsoft, and G is Google. As of 17 March 2021, their weightage on S&P 500 alone is around 20%. Other than classifying the stocks with their market cap, there are also several ways to classify the stocks. One of the ways is to classify them via different sectors. For example, technology, finance, consumer staples, energy, and etc. We will talk more about this in the ETF video. I hope you managed to take note of all these terms today. In the next video, we will talk about the brokerage platform to buy or sell shares and the terms involved. Please subscribe us and turn on the notification bell if you have not done so. See you in the next video. Bye-bye.